Most of us handle car ownership on autopilot. We walk into a dealership and immediately fixate on a single, highly manipulated number. Buyers frequently fall into a behavioral economics trap called monthly payment anchoring. We judge whether a vehicle is affordable based entirely on what leaves our checking account every 30 days, overlooking the total financial burden. This diagram reveals the AAA 2025 economic model. In a single year, owning and operating an average new vehicle costs $11,577. If you divide that total, the true economic drain is nearly $965 a month. Trusting a dealership's intense focus on monthly cash flow creates a financial blind spot. By ignoring the long-term categories of ownership, buyers risk taking home a vehicle that costs significantly more than they can actually manage. The largest expense of owning a car does not happen at the gas pump. It happens quietly, every single day, as the vehicle evaporates its inherent value. AAA data shows depreciation averages $4,334 a year, more than twice the average driver's fuel cost. This financial bleed remains invisible until the exact moment you try to sell the car or trade it in while owing money to a bank. Dealerships know buyers are sensitive to price, so they rely on a second major trap to artificially lower that monthly payment anchor: manipulating the financing terms. Take a $20,000 loan, stretch the timeline from 3 to 6 years, and the payment drops from $597 down to $320. But look at the hidden consequence. Total interest paid silently doubles to over $3,000. Ignoring daily depreciation while stretching out a loan turns a seemingly affordable monthly payment into a long-term debt trap. Moving past the loan, the vehicle continually drains a household's cash flow through unavoidable operating costs, starting with the highly volatile nature of auto insurance. Premiums are subjective. They fluctuate based on your driving history, your exact location, and the specific vehicle model. A national average won't protect you. A quote must be secured before the purchase is finalized. Then comes registration. Rather than a simple one-time fee for a license plate, it is a recurring burden of ongoing local taxes and government charges that hit you every single year. Finally, maintenance is an absolute certainty. AAA estimates wear, tear, and tires cost roughly 11 cents per mile. The timing of a blown tire or a dead battery is erratic, but the expense is inevitable. These compounded, inescapable variable costs demonstrate that a vehicle acts as an active, ongoing liability against your household budget. To escape the monthly payment illusion, calculate a true economic measurement. Add all fixed and operating costs, then divide by expected annual miles. AAA data shows 15,000 miles a year cost roughly 77 cents per mile. But that number is not a fixed destiny. The initial choice of vehicle category drastically alters the final equation. This infographic shows the financial penalty for unnecessary capacity. Choosing a half-ton pickup instead of a small sedan costs an extra $6,402 every year. The cost per mile metric acts as a filter for identifying unnecessary spending on towing and cargo capabilities that you rarely use. Before signing the paperwork for any future vehicle, apply these 3 steps to protect your budget. Step 1. Demand 3 distinct totals from the dealer. You need the full loan disclosure, a specific insurance quote, and the written out-the-door price with all optional add-ons stripped away. Step 2. Calculate your personal cost per mile. Use calculators provided by AAA or the Department of Energy to input your actual annual driving habits. Step 3. Build a dedicated monthly repair reserve. You can absorb inevitable maintenance shocks by setting cash aside even when the car is running perfectly. Achieving true financial literacy means abandoning the question, "Can I make this payment?" and instead demanding to know, what will this vehicle actually cost my household every year?